From an asset class perspective, we still are very much focused on office as being sort of the concern, if you will. But we are seeing some sort of signs of life in the office markets. I think what we're finding, too, from talking to those developers and owners of office assets, they're definitely moving toward making this a kind of almost a workplace, fun, entertaining kind of thing, sort of, and then that's helping. But nonetheless, I think the office market still has a good way to go before it fully recovers. And if it ever does fully recover in the way in which we who grew up in the 70s, the 80s, and 90s, and the 2000s understood the office sector to look like. Having said that, though, I think generally speaking, what we're finding is that a lot of these loans are being given more and more time. When I think about it from my sort of world,
Duration.
which is the debt fund side, the debt side of the business, the reality is that we're extending a lot of those loans that are coming due. I think the biggest significant challenge is that we are seeing loans that are coming due at a 4% mortgage rate, and they are going to 6 and higher. And so, to me, the challenge there is that not only have you seen degradation in the valuation of your asset, but now you're also seeing, sort of just impediment as it relates to how you're going to refinance this loan. And so, many cases we've seen, as I said, the loan extensions have been helpful, and I suspect that we'll continue to see that until the rate environment changes.
So talk to us about some of those other sectors. I'm thinking industrial, multifamily. You mentioned the experiential element to real estate, which is really taking grip of everything. Talk to us about hospitality. Are those sectors healthy?
Hospitality is doing okay. I'm just looking at, sort of, we focus on oftentimes, from a hospitality perspective, we see it holding its own. From our perspective, there's a bunch of maturities coming in the next couple of years. 2026 is huge. We have $875 billion in loans coming due, and a good portion of that is in the various sectors being.
I don't care. Can you get me a reservation at Rouse?
Where do you want to go? Let me know.
Rouse. It's like Rayo's.
Okay.
That's what matters. I look at this, Lisa, and of course the headline, the emotion here in New York City is like 10 blocks south of me, 8 blocks south of me, where we're doing an office to residential redo in the old Pfizer building. And it's a disaster. I'm not going to sugarcoat it like politicians have to. This thing is a huge worry. What does it mean for the office market if we're screwing up the first big office to residential construction effort?
Yeah. I'm not sure if it's as negative as you're suggesting, but
to
the extent that there are.
Would you let your kids go in that building right now?
Not right now.
No. Okay, thank you. Continue.
Once completed, I do think that I always worry about how do we deal with this sort of defunct these office assets, and converting them to something, multifamily potentially. If you think about it, the plumbing, all of the sort of mechanics of an office property kind of work on a multifamily side as well. You still have, the things that you need to convert that to multifamily. Is it easy? Is it inexpensive? Is it challenging? Permitting, all of that is extremely challenging, and yet we're starting to see more and more. I don't think it's a disaster. I think it depends on who you speak to and what assets and what properties and what builder you're dealing with. But to me, it's a one opportunity to do something with those office properties.
Explain to me the high-end K-shaped economy here. When I drive to work, if I have the Bentley, I go down Lexington. But usually if it's Uber, I'm going down Fifth Avenue, Damien.
Yeah.
And I turn left on 59th Street, and related as a hole in the ground behind the GM building. Is that the next 5 years' future? Is all the fancy people are building fancy skyscrapers?
I don't think there's sufficient space, honestly, to do that. And yet I consider that to be something that many of the large office property owners, for example, are very much pursuing recently.
Well,
right? So you're seeing a ton of it.
So Lisa, I'd like to ask you a question about, some of the biggest, private credit players, CRE players out there. I'm thinking the Apollos, the Ares, all these guys, and there are plenty more. But it's this back leverage which has me questioning. If you just look at the links they have to the big banks and how big banks are funding their ability to do development and do new construction, and now you look at some of the bank balance sheets and the fact they're going to have to buy more treasuries that may crowd out some of the lending that they can do to some of these higher risk elements areas in the market. Is that a concern for you? Do you see that being a problem for some of the players, their inability to source the capital necessary to build?
I think one of the securitization sides of that, and that discussion is an important one, is that we have this CRE CLO marketplace that has really grown significantly since first introduced not many years ago.
Right.
So we're seeing already year to date around 26, 27 billion in CRE CLOs. That's the funding mechanism for the debt funds, right, in many ways. And so there has become, and very quickly, this ecosystem that allows them to finance themselves via the CLO marketplace. And what we've found, it's a floating rate market exclusively. And so you see a lot of these folks who need floating rate, kind of capital investing in the CLO market.
Sounds like we've become London.